It's amazing how much appetite people have for these IPOs. What does that tell you about the broader markets right now?
Well, I think there's optimism. You have kind of a bifurcation going on. I mean, last week you had the longest position in gold. It was 2 standard deviations, so a z-score of 2. But at the same time, so that would tell you people are being defensive. But at the same time, people have the appetite for high beta, appetite for growth, a lot of optimism around the G20. But as you heard from Libby and Heidi, it probably is going to be a nothing burger in terms of being a substantive. So you have to be pretty careful how you're positioned.
Yeah. So tempted to make a Beyond Meat quip there, Anton, but I'll spare everybody. So rates have been the story of the last couple of months. You know, the stock market's recovering a little bit of its footing in June, but we're still talking about incredibly low levels for the 10-year. You've been saying for a long time you don't need high rates to do well in the bank stocks.
Right. But
how tough an environment has this been?
Well, I mean, if you look at Morgan Stanley's conference yesterday, a lot of regional banks talked about earnings for this quarter and loan growth and everything. It doesn't look like a real big problem in the short term. I think what we've said is, how long will the yield curve look like this? Is it going to stay here permanently? And I think that, you know, should we get into a tough time, the Fed, you know, will cut. I think they've told everybody that.
What would that mean for bank investors right now? Should they be cheering for a rate cut because that would, you know, make the economics look better for them? Or
over time, it would steepen the yield curve. So in theory, yes. But, you know, the reason for the rate cut is, do we get inflation? What does it cause? And, you know, again, whether we get nothing burgers or we actually get a deal or something, you know, I think the market was very optimistic we were going to get a deal. Then it got overly pessimistic. It's pretty pessimistic right now. Hard to imagine they strike a deal. But again, I'm not sure the optimism of a deal is in there. Everybody's very pessimistic about the economy.
But Anton, doesn't growth matter too? If cuts are happening also because GDP growth is slowing, or if the earnings season's choppy and profits are declining, that also could have a negative impact on financials as well as
Nadine, how would you be positioned?
Institutions.
Are you guys looking at financials, other parts of the market, the cheap, really cheap areas? What do you think is interesting here?
I think one of the mistakes is people look at valuations and say something's expensive and therefore has to become less expensive. Cheap can get cheaper, expensive can get more expensive. And what we've seen over a 20-year period, 2/3 of the time when GDP is decelerating, as it is now, financial stocks declined 2/3 of the time. So,
but it depends on how long it's decelerating.
I guess take a look at how we're thinking about it.
Yeah.
But no, yeah, I guess our view is it's pretty negative.